Good morning and welcome everyone to today's BetaShares webinar. My name is Cameron Gleeson. I am Senior Investment Specialist at BetaShares. I'm delighted that so many of you could join us today for a topic which I think is going to be quite exciting, cloud computing and our new BetaShares Cloud Computing ETF. Today we'll be joined by an industry expert. Barry Silic is Chief Technology Officer for Cloud Computing and Cybersecurity at Macquarie Telecom. And he's generously offered his time to take us through a high-level view of the cloud, but more importantly, answer some of your questions on what can be somewhat technical subjects. So we hope that this will be enlightening, interesting, and importantly, relevant for you. Just a little bit of housekeeping, of course. The information presented today is general in nature and is not personal financial advice. Please see a personal financial advisor if you wish to seek that out. Anything that I or Barry says should not be construed as a recommendation or to make an investment decision with relation to the BetaShares Cloud Computing ETF or any of the companies mentioned today. We will send you out a copy of this webinar likely tomorrow for yourselves, anyone who's listening, and also any of your colleagues that might have missed today's webinar will get a copy. We'll also send you a clip from the Channel 9 story on their breakfast program today about cloud computing, which features Macquarie Telecom, so that will be useful, I hope too. If we look to the screen there, you can see the toggle box where you can click to type in your questions. We really do want to make this a Q&A session to make the most of Barry's time. So please, as we're going through, type in your questions and we'll endeavour to get through as many as we can. Many of you will be aware that BetaShares produces an array of investor material, a lot of content on our funds, on investing generally, and on markets. Please have a look, go to our website, have a look around, sign up to Bassine's Bites, our weekly newsletter from our chief economist, and follow us through those social media channels shown below. At BetaShares, we consider ourselves the home of technology-related ETFs in this country. We have a range of exposures from those broad market technology flagship funds, for example, NDQ, our NASDAQ 100 ETF, Asian Tech Tigers, in Australia, our All Technology ETF, but we also have global technology thematics such as cybersecurity, artificial intelligence and robotics, and now cloud computing. So a bit of an agenda for today. Barry Silic will be introducing the cloud and talking at a high level. I'll then be leading through a bit of a discussion as to our cloud ETF, the investment thesis, how the index is constructed and some of the companies included. And then we'll turn back to Barry, who'll be the star of the show, to have him answer all of your questions. So without any further ado, I'll hand over to Barry.
Thank you, Cam. And welcome everyone to the webinar today. It's a little bit about Macquarie Telecom Group, the company I work for. So we were founded about 30 years ago. We are an Australian listed company. We pride ourselves on our customer service. So we have the highest NPS score, which is the Net Promoter Score of any Australian listed company. It's actually 3 times higher than the industry average. We own and operate data center facilities. It just so happens I'm actually in one today. So I am where the cloud lives. If you do watch that clip that the guys are going to share a link to, hopefully tomorrow, around today's show, they actually did a segment on our data center, the facility I'm in now in Macquarie Park, our Macquarie Park campus. And you'll get a little bit of insight into a facility that actually runs the cloud. We do have 4 business units. So we have our data centers, which builds the data center facilities. We have our telco business unit, which provides telecommunication services. So NBN links, dark fiber links, and SIP trunks. Government focuses on federal government and state government, and our cloud services business unit, which is the one I'm part of, which we focus on cloud and cybersecurity for the commercial sector. A little bit about me. So yes, I am the CTO of cloud and cybersecurity here, 20 years experience. I lead a number of great teams. and have an absolute pleasure of coming up with the strategy and the product and the future of our offerings. Fun fact about me, between year 1 and year 12 of high school, I attended 9 different schools, 5 different countries. If you want to hear more about that, buy me a drink and I'm happy to discuss that. But today we are here to discuss cloud. Cloud is such a almost overused term today because everything people start calling cloud. So there's certainly public cloud, there's certainly private cloud, and there's some people call it on-prem cloud. So public cloud, I always, when people say, how do you differentiate between these clouds? I always kind of say, if you don't know where your data is, you're probably using public cloud. So if you are using Gmail, if you're using Live Account, if you're using Hotmail, you don't actually know where your data is. You may be in Australia, may not be in Australia. Even if you think it's in Australia, you wouldn't know which data center it's in. That's normally public cloud. Private cloud is normally you have a little bit more understanding where your data is. So you might have a private cloud provider that tells you, look, your data is in this data center, this is the address, and they can take you there and show you approximately the racks where your actual data is. They can tell you these are your servers, and you go, okay, that's private cloud. And on-prem is quite obvious. It's probably in your server room, in your office. You open the door and you can actually see that's all yours. So that's how I describe the difference between the three. But ultimately, then people started using hybrid and multi-cloud and all sorts of different things. They're more marketing tools. Ultimately, every company today is a multi-cloud user, because even without realizing, we are using cloud. We're using cloud for OneDrive, we're using Gmail, we're using all sorts of things, even little things like SurveyMonkey. It's a cloud offering. So everybody uses so many different cloud providers, which ultimately make you a hybrid cloud user. But really, it doesn't matter which cloud you use. There's really only 3 things you want to get from from any cloud. You either want to get infrastructure as a service, platform as a service, or software as a service. So irrespective of the type of cloud you're using, there's only 3 services that you can get from a cloud: infrastructure, platform, or software. So thinking about those 3 things, and I'm sure everybody has seen this, layered approach, and the more you move over to software as a service, the less you give away, the more someone else is managing for you, versus a infrastructure as a service. Ultimately, you take more ownership and more control of what you're managing. The 2 things I want you to just focus on here. One is data. You can never give away your data. So it doesn't matter what you do, data is always going to be the responsibility of the customer. So it doesn't matter which offering you choose, data is yours and should always be yours, but also securing that data is always your responsibility. So people may secure the bottom layers, but data is always going to be the customer's responsibility. The other thing is the data centers. The data center is the common thing across everything, and that's the building that I'm in currently. So it doesn't matter which one of the 3 you use, your data should sit in a data center somewhere. And then on the infrastructure as a service, you're normally managing anything above what we call the operating system. And as you move over to the right, you're not managing much at all. To put some color to this and use some real life examples, the Macquarie Telecom Group, we have a strong private cloud infrastructure as a service offering and platform as a service offering. We also partner with Microsoft, and we then combine the Microsoft Azure infrastructure as a service and platform as a service offering with our offerings and solve business solutions for customers. A lot of people say, don't you compete with Microsoft? We don't see it as competition because some workloads are better suited for Microsoft and other workloads are better suited for private cloud. So we can combine those two together and help customers on the journey deciding where their workloads should live. AWS is certainly the largest player, public cloud player in infrastructure and infrastructure and platform as a service offerings. So they are larger than Microsoft. Microsoft is growing faster, but they're certainly large. If we then look at some of the other ones out there, so Office 365, or now they're calling it Microsoft 365, is a software as a service offering. So you subscribe to it, you would pay Microsoft or a cloud solution provider such as Macquarie, which rebuilds Microsoft offering for the amount of users you have subscribed to their offering. And I'm sure many of you would use that. If you're not using Office 365, you're very likely using Google Workspace, which was previously called G Suite. Again, both of these are probably the most known offerings out there around email and collaboration tools. Then it gets a little bit grey. So if we then look at Salesforce or Dynamics 365, they are, or some people would call them software as a service offerings. But ultimately, both of those require quite a lot of development work to get out what you actually want out of them. So they actually probably, I would call them more as a platform as a service offering, not so much a software as a service offering, because you do need to invest a lot of configuration time and more likely than not, development time to configure them the way you want specifically for your business. An interesting one is Xero. Obviously a company that has grown significantly. They've been in the market now for a long time. They provide an accounting package in a software as a service model. So initially, MyOb didn't have that offering, and they've really taken off. They're certainly an interesting company because Xero itself uses AWS as a backend for their offering. So if you are using Xero today, your data is actually sitting on AWS's platform, and Xero has developed their offering on AWS's platform as a service. The reason why they've done this is because it allows them to scale up and down very, very quickly and minimize their cost. So they're very aware that during business hours, there's going to be a lot of people using Xero. However, in the middle of the night and on the weekend, there's not going to be many people on their platform at all. So they've configured their platform to scale up during business hours and drop back down to minimum infrastructure during the low peak periods. This allows them to really manage their cost and lower their cost overall. What's interesting about Xero and why I like using them is the fact that they've chosen to use AWS as their platform for their software that they on-sell to their customers. But then they've gone and used Google for their email system and their collaboration tools. And then they've gone and used Microsoft Azure for their in-office applications. And the reason for this is to try and mitigate risk as much as they possibly can. So the thinking is, if AWS is having a problem, all their customers are having problem accessing their accounting systems, they want to be able to still service those customers via email and via their in-office applications. So their staff will still have access to Azure and Google Workspace, and they'll be able to service those customers.
Barry, I'll just come back online here. I think that was a really good explanation of the differences between infrastructure as a service, platform as a service, and software as a service. We were talking yesterday just in terms of another way of describing it, and obviously really good to look at company examples. I mean, you sort of described infrastructure as a service as sort of the nuts and bolts, whereas platform as a service is something that a software developer uses as a tool versus a software as a service as sort of an off-the-shelf product, which is a sort of subscription model. Do you mind sort of reiterating that description as well, just to reinforce?
Yeah, sure. I mean, continue. I guess if we stay with the accounting software type of analogy, right? I can certainly sign up to Xero, and that will be a software as a service offering. I don't have much say in how that platform is configured. Sure, I can do a little bit of configuration, put my logos on my invoices, and etc. Ultimately, a lot of the development has already been done, and I don't have a say how to configure that. On the other side of the scale, I could literally go to any infrastructure as a service provider and start from scratch. I can get my virtual machines, I can install my database, I can get my 100 developers to develop a off-the-shelf or a custom, not off-the-shelf, a custom accounting system for me. So I would be spending a lot more time configuring and developing my own package. Can I do it? Yes, anyone can do it. And I will have 100% control of how it's developed, what the processes are, and no one can stop me from doing anything. Ultimately, there would be infrastructure as a service because I have the ultimate control there. If I move into the middle one, which is the platform, in the platform, I then go to someone like AWS and I go, great, instead of me running a virtual machine and then installing a database on top of it, I don't want to be patching my servers. I don't want to be running my virtual machine operating system. I can go to Azure or AWS and get database as a service. And I then hand over the patching of the operating system and everything else over to them. I just have the database there. And I can then access that database and do whatever I want with the database. I can even outsource the high availability and disaster recovery of the database if I wanted to. So I outsource that to them and I go, look, you guys do that better than what I do, but I still want control of how I develop my application. I will ultimately lose a little bit of functionality by doing that. So I will lose a little bit of functionality by doing a platform as a service database than I would if I had an infrastructure as a service database, because they will take some ownership of stuff and they will tell me, no, you can't do it that way. We have configured it a certain way, and that's the only way it's going to work. So ultimately, I will lose control as I move up to SaaS, but more likely than not, SaaS is going to be the most cost-effective way for me to get an accounting package.
That's great. Thanks, Barry.
That's okay. If we then just briefly, before we jump over to questions, because I'm sure we'll have some really great questions, but if we look at some of the mega trends that are happening in our technology world today, cloud computing is certainly a huge mega trend. So we're seeing hyperscalers, which are some of the ones that we spoke about, really taking off. Some of the growth in those hyperscalers that have been announced for the last quota are quite phenomenal. 30% growth. If you go to Cloud Wars website, they've just recently announced the growth in all of the hyperscalers. It's all 30% for the Q2, or our Q2, I guess, for the financial year. So cloud computing in all forms is growing. One of the things that everybody's aware of, data has an exponential growth, and we're seeing that data growth drive some of the cloud computing growth as well. So data, a lot of people think data growth is because people are creating more data. That's true. Most of the data growth has nothing to do with people. It's all technology-based growth. So example would be we're seeing a lot more cameras out there, and they're all generating a lot of data that needs to be stored somewhere. A lot of the data is stored in public cloud and then accessed. If you are even at your home, you probably 10 years ago, you wouldn't have any cameras. Today, you might have a doorbell that has a camera on it. You might have 5 cameras around the house. All those cameras are probably connected to a cloud somewhere and pushing all their data up to the cloud. If you're driving a Tesla, I always find it interesting for the people that own an electric car, go on the self-driving mode and let the car drive for a bit, come back home, connect it to the internet, and just watch your router, your internet router, and how much that car is uploading data to Tesla. It's huge amounts of data. We're talking terabytes of data that gets uploaded to Tesla. So why? Because Tesla has a huge amount of sensors on their cars which generate that data. They upload that data, and then they actually now have all this great data about what the car has done and what it did recognize, what it hasn't recognized, what it did well. They use their data and then they need to analyze it. So then they use things like artificial intelligence and machine learning to analyze their data. Interestingly, that just creates more data. And then with that data that they've analyzed, they improve their software, update their cars, and then the cars generate more data. And it uploads back to their cloud and just kind of does this big circle, which they keep generating more and more data. So Tesla is a great car company, but really they're an amazing data company because they have so much data that's coming their way. Cybersecurity is a big one. I always say the more data we have, the more breaches we're going to have. And we are using more public cloud offerings. So yes, we are increasing our attack surface. Data security is a really important thing, and cybersecurity is certainly on the rise. IoT is going to continue to grow because everything is becoming enabled now. So we are having more things that are just connected to the internet, which is great. And we're able to automate a lot of the things, which is great. Quantum computing is something that's going to come in the future. It's probably not a megatrend today, but it's going to change the world like we don't understand. People don't understand artificial intelligence, but quantum computing is a whole new way of doing things. If you think about all the great encryption everyone has today, all of that is going to be able to be undone in seconds of the quantum computer when it becomes available and stable. It's available today, but not stable. That's it. Back to you, Cam.
Great. Thanks, Barry. So really all roads really lead back to cloud. And so we do want to, so we'll just move on. We wanted to talk about our cloud computing ETF. But just if we move forward, just a couple of slides there, just wanted to reflect on, the growth in this market. And, we know, Barry's talked about the growth in data driving this trend. We know about, customer adoption and how a cloud model can be more efficient. This is some global expenditure data from Gartner, and it shows the 3 key segments. So SaaS, which is the largest segment, over $100 billion US spent annually on SaaS solutions. And that's growing at roughly 17% per annum are the projections for the growth over the next 2 years. We also can see PaaS and infrastructure as a service, both growing at roughly 25% per annum. So we're just talking there about how really cloud has changed the game for an IT department of a company. So previously, the CIO would need to go out and spend lumpy amounts in terms of their budgeting. So we need to spend money on buying new servers from time to time every few years, upgrading our hardware. That'll all be stored in a cupboard somewhere. in the company, which is called the server room. We also needed to pay for software licenses from time to time and upgrade our software to make sure that we're keeping up to date, build in redundancy because we didn't know how much capacity we needed in our infrastructure, and hire an entire team to manage this process. So, obviously a relatively complicated thing, but also very lumpy in terms of cash flows. Using cloud, the scenario is far simpler for that CIO. They can pay a subscription-based monthly fee or a usage-based fee, which can scale up and down based on the actual requirement rather than any sort of guesstimate as to what's needed. You can use best-of-breed technology, and Barry's talked a bit about this, but we'll go further into it, how you can use different cloud providers to play to their strengths. And obviously, the resourcing requirements lowered, the requirement for patches, admin, maintenance, is all can be, very much removed if that's the desired path. So there's certainly a lot of advantages for the customer. Thinking about the companies, and the chart shown here on screen, the top right, shows the average revenue growth in dark blue, which has the axis on the left-hand side, average revenue growth of SaaS companies. So growing at 15% per annum, which is a fantastic growth rate. What's more impressive, I think, is the orange line shows the gross margin of these businesses, which is now tracking up over 72% gross margin. So for every $1 of client revenue coming in, 72 cents is going towards the bottom line. That's an incredibly attractive type of business, particularly if you're a growth-oriented investor. We think about investors who are buying growth companies. Typically, a growing company, because it's growing, requires increasing amounts of working capital. And that means often that you need to dilute current equity holders to raise capital to fund that growth. Whereas if you have a company which is spitting off free cash flow, that's an extremely attractive business. Now, that's the sort of thing you want to hold because the company's able to fund its own growth, and just talks to the strength of some of these SaaS companies. If we think to the infrastructure as a service style companies, and for example, AWS, so Amazon AWS, that's running at gross margins of around about 32%. So still a very strong degree of revenue capture, and certainly the most profitable part of Amazon's overall business. The other point I would make probably on these companies is SaaS companies in particular, and really all cloud companies, you don't just have exposure to a single industry. So for example, you're not exposed to just financials. The revenue stream is coming across all sections of the economy. So customers of accounting software or a CRM or sales management tool, HR software are going to be used, that's going to be used across financials, consumer discretionary, consumer staples, resource companies. So there's a wide spread of where that revenue is coming from. So very resilient revenue, sticky income. So you can now access a portfolio of leading global cloud computing companies through BetaShares Cloud Computing ETF. This ETF trades on the ASX under the ticker code CLDD. As it is an index tracking ETF, it of course comes with a lower level of management costs, so total management costs of just 67 basis points. This ETF, really pleased with this. We've got a lot of reverse inquiry for this style of exposure, or this particular exposure to cloud computing. We managed to launch this earlier this year, so February, the 22nd of February this year. Been running for about a month, available on the ASX today. I did want to go a little bit through the index methodology, and so we'll talk to it through this slide here that you can see on screen. The index provider is confusingly called index with double X, but it's the Index Global Cloud Computing Index that this particular ETF tracks. And companies included in the index must have revenue through the 5 sub-themes shown on the left-hand side of the chart. So the main sub-themes within cloud computing, as Barry went through, are SaaS, PaaS, and IaaS, or infrastructure as a service. So these are all products or services that cloud customers use. But if we think about that provider of infrastructure, in order for them to operate, they need a place for the cloud to live, a data center, such as where Barry's sitting right now. So we also include a small portion of data center REITs. And we also have the capacity to include providers of hardware and components that are needed to build those giant server banks and configure those data servers. So it really is an exposure across cloud computing as a whole. We do note that the exposure is designed to be a more pure play exposure. If we think about cloud computing, there are a number of large companies, and we talked about Microsoft, Amazon, who have relatively diversified revenue as a whole, but are very important players within the cloud market. So the allocation of those large public cloud companies, where their revenue is less than 50% of the company's overall revenue, is limited to 10% of the index. 90% of this index is reserved for those pure play cloud companies that have at least 50% of their revenue, and usually much more, a higher portion of the revenue generated from these cloud-based themes that you can see on screen. So, if we think about, look, some of the names, Shopify is a SaaS, or arguably a PaaS provider. It helps online retailers with their payments, their marketing, their shipping, and their customer engagement tools. It's really an online shopping cart solution. Twilio is a PaaS which provides the ability for developers to programmatically manage communications with clients of a company, and also clients and stakeholders. So we're thinking about emails, text messages, and phone communications. So make companies more efficient in that engagement with their own companies. Workday is an HR software solution which was formed by some of the previous leaders of PeopleSoft. And CyrusOne is a data center REIT based in the US. The performance of Clouds Index has been very strong, particularly over the last 5 years. We show that performance versus MSCI World, so broad market world exposure. So roughly, up to 40% per annum over that 5-year period, even stronger than the NASDAQ 100. And look, this is not surprising given the growth in revenues that we've seen for the companies in this particular segment of the technology world, and that feeding through to now very strong earnings growth in these companies. Of course, with all investments, there are risks to consider, and cloud is no exception. I'd encourage you to go to our website. There's an array of material. You can look under the fund page for cloud and see the PDS, performance, the current stock holdings, and some stories around some of those stock holdings. So our website's a great resource for further education. I'd now like to invite Barry back onto camera, and we will run through some questions. And we've received a lot of questions prior to the webinar, and also questions from today. Welcome back, Barry.
Thank you.
So there are some questions that I'll answer, but I think people really want to hear from you on some of these. I'll just start off with a question around penetration of cloud computing. And I'm sure you don't have the exact figures to hand, but can you give us a feel of the penetration of cloud computing in Australian businesses versus overseas? So, for example, markets such as the US and UK.
Yeah, sure. Look, I would say I have not spoken to a business in the last 2 years that has not had some cloud computing solutions. And so I guess from that type of penetration, I would say 100%. Every business is using cloud. From a penetration point of view as to how much of their work, or what's the percentage of their workloads that are currently on cloud versus non-cloud, probably depending on the market segment, it will vary quite a lot. But on average, I would probably say less than 50%, I would say, is in public cloud currently, or private cloud even. So there's still a lot of workloads that are not on cloud. In fact, just talking to Microsoft and AWS, my friends there, they're seeing that's their biggest opportunity. So they, talking to Microsoft and AWS, they don't tend to talk about each other a lot because their focus is not about competing. Their focus is about migrating workloads to cloud from on-prem. Yes, certainly they hit high fives when they beat each other in accounts and migrate a bit of workloads, but that's not their focus. From a global point of view, Australian market has always been very quick to adopt technology. So penetration in the Australian market is higher than in the US, and that's always been the case. We're quite fast to adopt technology and change. And in fact, a lot of corporate international businesses use us as a bit of a test bed. So yeah.
That's interesting. Good to see that we're leading the way, or at least up there with the leaders. So the next question I had, and I'll start by providing some answer and just throw to you, Barry, after that. But if cloud is going to become a utility, just like electricity or water, what is the proposition on attractive returns? So just reflecting on that, obviously, I guess the argument is that cloud becomes so prevalent that it becomes a commoditized product. Obviously utilities are usually regulated in terms of their pricing, whereas cloud computing is not. And given it's a global market, it's unlikely to be regulated. I will say, and just in discussions with you, Barry, it's been very interesting. Obviously, these cloud providers have a lot of pricing power. SaaS solutions have a lot of differentiation in their product and particular strengths in particular areas that mean that they are the go-to solution. If we just think of Salesforce, for example, or Xero, really strong solutions. And so people will use them and will pay a premium because they're better. If we also talk to even those public cloud providers, just reflecting on some of the things that we've talked about over the last week, they've clearly got different strengths in different areas. And so it's not a generic product, but also the economies of scales that they operate at really mean that they do have pricing power and can extract value out of providing this service. I don't know if you wanted to add anything there, Barry.
Look, I think you've summarized it quite well. If we talk about the infrastructure as a service bit, I would agree with the statement in the question that that's becoming commoditized. And if you look back probably in the last 8 years, especially the prices in that area have come down a lot. Probably stabilized in the last 2 years. I think they've kind of hit the bottom in a lot of the areas, especially around storage and stuff like that. But as you move up into PaaS and SaaS, that's where the IP comes in. That's where your differentiation comes in. So when we talk in infrastructure as a service, we talk about CPU, RAM, and storage. That's all you got to talk about. And how much compute power am I going to get? How much RAM am I going to get? And how much space I'm going to have for storage? That's it. As soon as you start moving up, that's where the differentiation comes in. So in the SaaS world, there's always going to be the differentiation, and people or companies such as Xero have developed that utilizing the commoditized, let's say, vanilla cloud offerings to really have a great product out there in the market. From a differentiation from a public cloud providers, we have our Amazons, we have really the three big ones today are Amazon, Azure, or Microsoft with Azure, and Google with their GCP. They all, if I look at our enterprise customers, or really all enterprise companies at the moment, they're quite sophisticated in working out which workloads go best on what cloud provider. Each of them have strengths and weaknesses. If you look at GCP, which is the smallest out of the three, they have a really great analytics platform, which is really their Google search engine, which then gets white labeled and I guess provided as a PaaS offering. So if you want to analyze a lot of data, BigQuery from Google is amazing. And a lot of companies understand that, and they would use Google for that. But if they want to run a web workload, they probably go AWS, and if they want to run a database SQL Microsoft type of workloads, they'll go Azure. That's just an example. Some would switch between them, but ultimately they understand their workload and where they're best fit. Similarly with private cloud, they'll go, well, this is quite a static workload, and I'll get best value out of private cloud and not public cloud.
That's great, thank you. Another question for you, Barry. What are the potential downsides in this field, or I guess industry? Can it be disrupted?
Everybody, when we talk about cloud, the word cloud used in the technology sense is fairly new. However, the technology behind it has been around for a long time. We've had data centers for much longer than we had cloud, the name cloud. We just didn't call it cloud. We called it hosting. You had your stuff hosted somewhere, and that's it. So the technology on which cloud is built has been around for a long time, and it has proven itself. In fact, some people would argue that when we had mainframes back in the day, that was part of cloud because it was centralized computing. We've now moved into centralized computing again, which allows big hyperscale providers to have the scale to offer a really low price point. So the technology has proven itself. It's been there for a long time, and I'm not really concerned that that's going to go away. I think what we'll see over the next probably 5 years is iterations of that and mixing that with things like edge computing and where edge computing comes and how does edge computing connect to cloud computing and how do we make them work together. So I don't think it's going to be disrupted. I think it's going to be iterated over a period of 5 years, 10 years.
Great. So there's a few questions here about the CLDD ETF. So I'll answer them. The first one is, will it include smaller companies as well as established ones, especially those who are with leading innovative products and practices? Will new IPO stocks be added? The answer to both is yes. There are index rules. There are requirements that companies must have market capitalization of greater than $200 million US, and there are requirements around traded liquidity of those stocks. But that certainly doesn't allow the inclusion of smaller companies, particularly those that are very focused in cloud computing, so have a high amount of revenue in cloud computing. IPOs are included, typically included after a 6-month window, although a very large IPO can be included within 10 days. So it will be an index that evolves as the index evolves, and we know with technology, it's very difficult to predict the future. So we want to make sure when we're selecting an index, we're selecting something that really does future-proof us. There was a question about data centers being, are they included in the index? There is an allocation of data centers that have the majority of their income from cloud computing. They're capped at 10% of the overall index, but an important part nonetheless. Does the ETF focus on cloud computing companies from one country? No, so the companies can be included from across the globe, both developed markets and emerging market companies. And is there any focus on dividends growth? This is a growth-oriented exposure, so there really is a very low level of yield that you would expect. Given these are very profitable businesses, they tend to reinvest their profits in the business. So I wouldn't suggest this would form the bedrock of your portfolio yield. Got some, so just to get through those so we can get back to Barry. What is the first step a business takes in migrating to the cloud? What's the easiest cloud solution?
The first step that people normally migrate is their email system. And if you haven't migrated that already, you should. The reason for that is emails are not latency sensitive. So if I get an email now in 2 seconds time, I really couldn't care less. So it's probably the easiest thing to migrate, and it's probably the safest thing to migrate. So yeah, that's probably the easy one. From then, at Macquarie, we do a trusted advisor program, which takes companies through that journey and then figures out which workloads they should migrate next and to which platform they should migrate them.
Okay. Do you have any indications, and appreciate this might be sensitive, but any indications as to how much a business saves by migrating to the cloud?
Oh, the quick answer is probably it depends. It depends what you're migrating and to which cloud and how the cloud is configured, and if you're managing it, if someone else is managing it, and all sorts of stuff. So it's not an easy question. Again, that would come out in quite a detailed process that we go through with companies. But you would expect to save money, yes. How much, that depends.
Perhaps a different way of getting at that is the next question, really about what rates of customer satisfaction, but really more importantly, what rates of customer retention do you see? So obviously, if you're seeing customers stay on the cloud, then I assume that it is a benefit to them on a net basis.
Yeah, that's a great question. Customer retention. So if companies moving to SaaS tend to have a lot better retention. So we don't see too many people moving to Office 365 or G Suite and then moving again. They kind of stick there. Customers moving to especially public cloud infrastructure as a service, we're seeing a lot of them, especially 5 years ago, people would have went, yep, all in with Azure, or all in with AWS. And now they started to realize that that's probably not the right strategy. They need to figure out which workloads are best suited for their cloud and extract the workloads that are not suited for that cloud. So we're seeing some customers kind of move out of the infrastructure public cloud play and putting it back on private cloud for the static workloads that are very predictable versus the elastic workloads that are very well suited for public cloud.
So it sounds like people are getting more sophisticated with their use of the cloud and different cloud solutions, whereas they might have just jumped on to begin with. They're differentiating where there are strengths. Is that accurate to say?
Yes, I would probably go a step further and say they're forced to get more sophisticated because of the bill shock they sometimes get from hyperscalers. So you don't get a predictable bill. You get a consumption-based bill, and once that bill comes at the end of the month, then they, go, oh my God, I can't believe I have to pay that, and then they're forced to rationalize those workloads and figure out where they should fit. And again, so we,
yeah, okay. So there was a couple of questions about sort of valuations and I'll ask one of these questions and reflect on it myself. Do you feel there is a heightened downside risk considering fundamental valuations of tech firms? And it goes on to talk about the ETF tracking index. I just wanted to talk about valuation. So if we look at the cloud index, and I checked this just before, the people will often compare investments or equity investments based on a price to equity ratio. It's a shorthand measure of essentially saying how much are you paying for the earnings of a company. Price to earnings ratios are typically either the previous 12 months earnings or the next 12 months earnings. So the PE ratio of the cloud index is currently 69, which sounds really high, and in isolation it is. The important thing about looking at PE ratios, particularly if you're talking about a long-term growth story or growth thematic, is that you can't just look at a PE ratio in isolation. You've got to consider the growth rate of firstly revenue and then how that plays through to earnings. So a really interesting example of that is Xero. So if you looked at the PE ratio of Xero a year ago, their PE ratio sat at roughly 4,400, which sounds incredibly high, sounds very expensive. But that's because Xero had only just turned a profit for the first time and had made a very small, very incremental profit. I think it was a couple of $1 million for a relatively large business. So this is a story of a company which is on a real, a growth trajectory. And so its PE ratio, when its next earnings were announced, dropped from that 4,400 down to around about 500, which again still sounds high, but is merely a fact that the earnings, if you like, are catching up to what the stock price has done. And if we look forward, consensus growth rates on Xero's earnings sit at roughly 100% for the next year. So again, we'll see that PE ratio come down. And I guess the point I make on growth exposures is they can seem expensive based on current earnings, but you really have to think through what does that earnings profile look through. And if we project out that that simple roughly 100% growth rate, we see that on a PE basis, looking 4 years forward, Xero actually looks relatively cheap versus its earnings stream 4 years forward. So it is difficult to compare these stocks, and I encourage you to do your own research. But we should note that it's important to consider, if you're looking at a price to earnings ratio, also look at the growth rates and the risk that you see around those earnings or the projections of those earnings. So I've talked enough about that. Barry, you also cover cybersecurity, and I mean, I've certainly read that generally speaking, using the cloud is considered to be more secure than saving something on your phone or your computer. And you mentioned in your part of the slide pack about how the security for data, i.e. your own password to your account, is still user responsibility. Can you maybe talk a bit about cybersecurity in the cloud?
Oh, yeah, I would certainly agree with the statement that generally speaking, cloud is more secure than on-premise. And the reasons for that is, if you think about those three stacks that we had, the more you move over to SaaS, the more responsibility you're giving away to your provider. So you certainly need to make sure you have selected a provider you are extremely comfortable with and is being audited and understands, obviously, security themselves to be able to secure everything that they're responsible for. If you have done your due diligence on that, then that provider should be a lot larger than their customers, and hence be able to concentrate on that security a lot better than an individual customer can. Ultimately, I always say the due diligence is on the customer and your data is always on you. A lot of people have assumed in the past, and I hope they don't anymore, but just using cloud, you're secure. That's not true. There's a lot of configurations that you need to do to make sure that your data is secure. So if you are using Office 365 and Cam, if I give you my password, you can access it, you can extract all the data you want. So a lot of the responsibility is on the customer to ensure that they're using things like multi-factor authentication, conditional access, which are all configured. You can configure them, but you can choose not to. So it is on the customer to utilize the tools provided.
Great. Thanks, Barry. Look, we've gone slightly over time there, and I just wanted to, on behalf of the audience, I'd like to thank you, Barry. That was extremely insightful, and really good to get a detailed look at this particular area. Certainly, I found it interesting, and I hope that everyone on the line has too. So I appreciate your time.
Absolute pleasure. Thanks for having me.
Of course. We'll have to have you on again to talk about cybersecurity next time. So thank you very much, everyone who joined us today. We will send a copy of the webinar recording, as we mentioned, that Channel 9 show, which is also interesting, to your emails tomorrow. Well, we appreciate your time, appreciate your support of BetaShares. We hope you have a great day. Bye for now.